Winning in this market will not be easy. Fortunately, we've got JJ Kinahan, Chief Market Strategist of TD Ameritrade. How's it going, JJ?
Great to be here. Thanks, Jay.
So first question is, let's talk about Facebook. It's been a volatile year for Facebook. Is Facebook going to give us anything to like in 2019?
Well, you know, sometimes you get companies that get in this, the targets of the government, shall we say, a little bit. They've had a lot of news there over the last 6 months, let's be honest. A little bit of trouble getting out of their own way recently. Bad stories continue to come out. This tends to be a cycle that doesn't go quickly. In my opinion, you're probably in the middle part of this cycle, so to speak. So if you stay long Facebook, not necessarily a bad company or anything like that, but there's going to, in my opinion, be continued news over the next 6 months or so, where you might have to deal with some of the volatility that goes along with that type of news. Their core business, though, is still a pretty strong business overall. But again, I think what you're weighing now is, will the potential volatility of news make this continue to be a tough hold, so to speak, as we head into 2019?
So if that's the case, does it leak into other FANGs, maybe fairly, unfairly a little bit?
I think that sector in general, as you've seen at the end of the year here, it was, I want to use the word hiding out, so to speak. When other things were volatile, people would go there as sort of a safety play for the momentum stocks. Well, that's busted. So I don't know necessarily that it's that Facebook news bring it down as much as the fact that they are not trading as a hideout stocks anymore. The news that comes out affects them all. When the market goes down, they're not just a place that we're going to go up. And as you've seen a lot at the last month and a half or 2 months, it's been interesting to me how well many days the market's held up without any of those momentum stocks having good days.
And then Apple, how should long-term investors think about Apple?
Well, I think that right now, you know, Apple's being reevaluated. They themselves came out in their last earnings call and said how we conduct our business is changing. We don't want to consider ourselves a hardware company anymore. We want to consider ourselves more of a services company. Well, that's pretty tough on the valuations when iPhone is 56% of your revenue. And so what we've seen is from some of the suppliers, we just had Sears come out yesterday and say that as a supplier of Apple parts, that their sales are going to be slower for the first quarter of 19. So when your suppliers, I believe that's the third one that said that they're not going to have as good a quarter as they expected, when your suppliers are saying they're slowing down, that probably means your product might be slowing down also. So I think, you know, this is one you're really going to have to evaluate your time frame, and I'm glad you asked on the long-term investor type thing. Because if you have a year or more, there's going to be some volatility, I would believe, in the first couple of quarters. But they have a very good management team. Their services business has been growing pretty significantly. So if you're a longer-term believer that they can continue to expand iTunes, et cetera, then fine. But holding on to that, realize there's going to be a lot of ups and downs in there. And the last thing I would say for anybody investing there, you and I have talked about it on the show before, don't be all in, so to speak, or all out. If you have 500 shares to buy, maybe think about 100 or 200 so that if we do get some downdraft, you get to buy some more at a better price.
And on top of the issues for Apple, where you might want to mitigate some risk and not go all in, no 5G in 2019. Verizon and Samsung's doing it. They're going to wait. Apple's going to wait till 2020, and there's actually some news that they're actually doing some discounts on some iPhones.
It all plays back into that same story a little bit of, if you're not hardware, you don't have to be the first one out there, so to speak. And the other thing is, if you are having a little bit of trouble in your supply chains or whatever it may be right now, or with some of your sales, maybe it is a time to sort of wait and see and come out with the second version. You know, as you and I know, cars, phones, whatever it may be, sometimes the first version is not necessarily the version you want to own. The second version can learn from the first version's mistakes.
Let's hit retail really quickly. Retail's interesting. Obviously, a lot of discretionaries in the sector. 2019 might slow down against 2018. How do you think about retail?
The consumer has proven to be incredibly healthy. And so, you know, every time you want to discount the sector in general, I think it's a mistake. In my opinion, there is no sector in the market that is more individually name-driven than retail. You know, some names do great, some names do terrible, but it's all name to name to name to name. This is really, if you're investing there and you're thinking about earnings, this is really more hand-to-hand combat. You really have to be more selective in the names you pick because they vary so greatly, and you see it with fashion particularly. You know, You think about stuff like American Eagle and Abercrombie and Fitch. Abercrombie having a great quarter. 2 years ago, nobody wanted to touch Abercrombie. So, as tastes change, that happens a lot too. Now, if you talk about some of the bigger stores, you go into, you and I were just talking off camera about Kohls. Well, Kohl's, Walmart, and Target are really interesting to me because those are three stores that usually aren't as reliant on mall traffic. They tend to be independent brick and mortar stores. They kind of encapsulate you once they get you in the store. Their challenge is always to keep you coming into the store overall. You saw a couple of weeks ago Kohl's, great earnings. Really were good, but it was on a day where the rest of the market was just getting whacked. There was some bad retail earnings the day before. They got smashed on that. Now, rightfully so, in my opinion, they've come back almost 10% since that day. So again, the challenge for retail is you better beat, but more importantly, you better have those same store sales beating expectations and give nice guidance going forward.
And so with that picture, you're looking at competition and everything is so individualized in that sector. Kohl's is trading at 11 times trailing earnings. How do you go bargain hunting and looking at different names in retail?
That's a great point because as I brought up Kohl's versus Walmart, Walmart's going to be more reliant on groceries, Kohl's on perhaps goods. So, you have to separate that way. Then the next way you have to look at it is, okay, are you a believer that the consumer stays healthy in 2019? As we continue to have sort of this tariff overhang, we just had great news on it, but we don't have any details, and the longer we kick the can, I think the more it's going to start affecting the consumer longer term. It's great that we kicked the can this time, to be very honest with you. So I think that when that, there's always something, so to speak. The consumer's doing well. I think it really comes down to your longer term belief on if the consumer does well, that valuation might seem a little bit on the low side. If the consumer does slow it down at all, though, I think that's the one time the sinking tide will take all boats with it.
And so if you want to be defensive in the face of that point that you're making there, what are some consumer staples an investor should look at?
Well, I think a couple that have been interesting recently have been Procter Gamble, Coca-Cola, and Pepsi. And those three I'm saying because if you go back, we had 3 weeks of bad market. Those three stocks performed really well during that bad market. Why? What do they share in common? Very consistent earnings, very consistent product, and very consistent dividends. And when you're looking at a 10-year rate that's now having trouble getting away from 3%, when people are I won't say afraid of bonds, but maybe a little more reluctant to go into fixed income. So if they can find a blue chip staple company that pays consistent dividends, that seems to be actually, as much as sugary beverages, et cetera, get ripped, expanding their businesses through other products such as water. Procter & Gamble continuing to perform. Those are things people need, and I think sometimes people forget it's not just the U.S., it's a worldwide company that's doing very well. So I think that they are using those stocks as almost a substitute for fixed income.
Now, Procter & Gamble had some trouble in its last earnings report because of the strengthening dollar, which hurt them internationally. Okay, so if that's the case, and we are and maybe the Fed is a little bit more dovish than it was before, but we're in a rising rate environment. How do you think about P&G?
Well, I think about P&G, as I said, the fact of the matter is we're still having trouble getting away from 3%. We may be in a rising rate environment, but there's been a disconnect between the goal and the actuality. And so if we start getting some momentum around rates going higher, I do think that, that's a stock that people may segue out of into some fixed income. But right now, it's been looking pretty good to people from that point of view.
Talking about rates, some banks have been down. Goldman Sachs has been down. Citi's been way down. How do we think about financials?
Well, obviously you covered yesterday the inverted yield curve. It's been the talk of the town, so to speak. And so, in just a part of it, so let me be fair. If anybody hasn't seen that story, just a small part of the yield curve, and you got the 2-10 spread only at about 19 basis points, which is incredibly low overall. So, what does that mean? Well, first of all, the regional banks have really taken it on the chin with that. Why? Two primary reasons. Number one, the yield's not increasing on the longer end of the curve. Number two, regional banks were a place people were going because of a hedge for what was going on tariff-wise, because if we did go to these higher tariffs, there might be more domestic type banking, Russell 2000 type stocks of our regional banks. That didn't happen, so that gives some momentum to the larger banks. However, if the long end of this curve doesn't come up, it really becomes more difficult for them. The one thing I will say about the larger banks is they become so well managed, and they've gone through this over the last 10 years of a tough rate environment, yet they've still found ways to make money and really, really are tight on expenses. So they can do okay. The conundrum for everybody has been every time you invest there, they just, stay in the sand, so to speak. And I think for most investors, it's been the most frustrating place to invest in 2018. I don't necessarily see that easing up for the first quarter of 2019.
Every time, you think the banks are about to get going, they don't.
Yeah, they stay in the sand.
All right, thanks, JJ.
All right, Jeff, appreciate you having me.